Impairment of assets. Impairment of assets means that an asset of a business has lost some of its value, and now it is worth less than what is shown in the books of accounts. A business may buy assets like machinery, building, computers, vehicles, etc. Sometimes these assets become less useful or less valuable because of damages, wear and tear, old technology, market price fall. When this happens, the asset's recoverable value becomes lower than its book value. Then we say the asset is impaired. For example, suppose a machine is shown in the books of accounts at $50,000, but due to damage or old technology, the machine can now fetch only $35,000. So the difference of $15,000 is called impairment loss. In simple words, impairment means that the asset is not as valuable as before. So the business must reduce its value in the books of account. An entity shall assess, at each reporting date, whether there is any indication that an asset may be impaired. If any such indication exists, the entity shall estimate the recoverable amount of the asset, irrespective of whether there is any indication of impairment. An entity shall also test an intangible asset with an indefinite useful life, or an intangible asset not yet available for use, for impairment annually, by comparing its carrying amount with its recoverable amount. This impairment test may be performed at any time during an annual period, provided it is performed at the same time every year. Different intangible assets may be tested for impairment at different times. However, if such an intangible asset was initially recognized during the current annual period, that intangible asset shall be tested for impairment before the end of the current annual period. Test goodwill acquired in a business combination for impairment annually. According to IAS 28, an enterprise should assess at each balance sheet date whether there is any indication that an asset may be impaired. If any such indication exists, the enterprise should estimate the recoverable amount of the asset. If any asset is carried at more than its recoverable amount, the asset is described as impaired. As IAS 28 requires the enterprises to recognize an impairment loss, it ensures that its assets are carried at no more than their recoverable amount. Thank you for watching, guys. If you found this video helpful, hit that like button and leave your valuable advice below. And please subscribe to our YouTube channel so you never miss an update, and share it with your friends.